Okay, well, we'll get started. I know a few more people will be joining us as we proceed, depending on everyone's schedules. We have about 25 people online right now, and we had more registered, so hopefully more will join us. Good afternoon. I was going to say morning. Who knows what time it is anymore? My name is Elaine Garvey. I'm the Senior Associate Director for Elliott School Alumni Programs. First, I just want to say that I hope everyone is staying safe and healthy as always, as we're now in week 6, at least for most people, I think, of staying home and keeping healthy and safe within our environments. So I hope that continues, especially as some people are starting to venture back out and potentially going back to work. So we'll see how that all works out, but keeping our eye on the news and making sure that we do what we can to keep things moving smoothly. So I wanted to welcome Diana Henriques to this kind of new platform that we're using in these times. We started the last few weeks trying to schedule some of these virtual events so that we can still reach out and engage with our alumni and the Elliott School community, including students and faculty. We have opened this up, these sessions up to the entire GW community. So we do have alumni and students from all over the university, and we welcome everybody. I hope you find this very enlightening. We do have 2 more sessions that are scheduled in the next 2 weeks. So if you want to learn more, you can go online. The short URL is go.ewu.edu/ESIA Experts Weigh In. And there you'll see that we have one next Thursday, April 30th, with Jeff Lightfoot, who's an alumnus. He'll talk about transatlantic challenges and opportunities. And then the following week on May 7th, Professor Maggie Chen will talk about the global economic system and the edge of coronavirus. So those are the only ones we've scheduled right now, but we are looking at potentially others. And so keep your eye out if you're interested in these sessions. The one we had last week with Professors Hope Harrison and Kimberly Morgan on the European response, the recording for that is now posted on that same website, and so you can download it to view if you hadn't had a chance to join us last week. It's now my pleasure to introduce our speaker, Diana B Henricus. She's an undergraduate alumna of the Elliott School, and for those who are on campus frequently, may have seen her lovely photo on one of our pillars in lobby of the Elliott School. So she is definitely one of our prominent alumni. She is an award-winning financial journalist and is the author of A First-Class Catastrophe, The Road to Black Monday, The Worst Day in Wall Street History, which was released in September of 2017. So that certainly will provide her with a lot of background for today's discussion. She's also the author of The Wizard of Lies, Bernie Madoff and the Death of Trust, a New York Times bestseller, and she played herself in the HBO television movie with Robert De Niro, which was very exciting, and 3 other books on business history. As a staff writer for the New York Times from 1989 to 2012, and as a contributing writer since then, she's largely specialized in investigative reporting on white-collar crime, market regulation, and corporate governance. Diana also served on the GW Board of Trustees from 2011 to 19 and was a member of the Elliott School's own Board of Advisors for more than 10 years. And we have greatly appreciated all of her advice and wisdom and whatnot that she's provided to us over the years. So with that, I am going to mute myself and turn it over to Diana. One quick note, you could have for the participants, you won't be able to see yourselves on the list, but if you have a question, please do enter that into the chat, and we will ask that of Diana later on after she's done her introductory remarks. So go ahead, Diana.
Thank you, Elaine. I'm delighted to be part of this new format for interacting with alumni. I wish we could all get together, but those happier days will come. I have to tell you, I hope you are all paying close attention, because as an amateur financial historian, I have become increasingly aware that we are living through a time that's going to be written up in history books for centuries. This is absolutely an unprecedented financial, civic, and economic experiment for the United States, and how our financial institutions, our economic machinery, and our political institutions come through it will be the subject of too many PhD theses to count in the years to come. So pay attention. You're living through history right now. My particular focus in several books that all sort of add up together, including a new book I'm working on now about the initial effort to regulate Wall Street with the creation of the SEC during the New Deal, has plunged me into a lot of market crises. And what I'm going to try to do today is share with you some ideas about the way history, the lessons of those earlier crises, can help us think about the crisis we're going through today. I'm not going to focus on the public health crisis. The GW has even greater expertise, far greater expertise than me to discuss that. But I'm going to talk about the market experience and the lessons and potential consequences of that. So first, I want to make a key distinction that we often miss, and it's just because market downturns are so scary. I understand that. I've watched my 401k go down too. We must always make a distinction between price meltdowns, which is what we're having right now, and market machinery meltdowns, where the actual machinery by which assets are traded starts to falter. When that happens, you can't find out what something's worth in any reliable way. You can't sell it at any reliable percentage of its previous value. So prices go down and prices go up as long as the markets that are setting those prices remain relatively healthy. The natural forces of the economy will modulate that price decline. So when you see that the Dow is off 700 points, and you see it's off 3%, by the way, don't pay any attention to the absolute numbers. What matters in terms of market movement is percentages. Just to give you a frame of reference, the worst day in the 1929 crash, the Dow was off about 13% in one day. On Black Monday, 1987, it was off 22.6% in one day. Now, we haven't had anything remotely approaching those kind of meltdowns today. So keep your eye on the percentage ball there. So price meltdowns are to be expected when you have so much uncertainty, so many catastrophic predictions and fears. Prices are obviously going to react to that. What we need to watch, be able to assess where this crisis is going to roll forward, is how the machinery of those markets is holding up. Let's take a quick historical review here. In 1929, the New York Stock Exchange, which at that point was the dominant place to trade stocks in the United States, there wasn't a NASDAQ, there wasn't any other viable online platforms, obviously, in 29. The Big Four, the NYSE, held itself together. Some lucky leadership, some relatively healthy firms held the NYSE together, but the banking institutions in the United States slowly started to crumble. Actually, they started to crumble slowly and then rapidly. So by the eve of FDR's inauguration in March of 1933, there were bank holidays, which is to say bank shutdowns in every state in the Union. We had no functioning banking system by 1932. So the market for securities held itself together, but the banking system fell apart. In the 1970s, which was a slow motion crash, we don't remember it much today, but it's really important for how Wall Street developed. In the 1970s, the banks held together. The 70s were a time of raging interest rates. Banks were benefiting greatly from the amount of money they could earn on the assets they had invested. So the banking system held up very well, but Wall Street just shriveled. My old editor, Alan Abelson at Barron's Magazine, where I used to work, had a tombstone ad it framed up on his office wall, those big full-page ads that would run in the Wall Street Journal, announcing some underwriting that was being sold. And of course, they'd list all the firms' names who had participated in the syndicates. And he had one of these tombstones on his ad from the 1970s. Every single firm on that tombstone was dead. It had been absorbed or closed its doors during the 1970s. The 70s were a terrible time on Wall Street. It drove a whole generation of Wall Streeters into retirement or into other jobs where they could make some money, which meant that a whole new generation came aboard in the 80s. And then 1987 came, and that new generation was not really prepared for the dislocations that were going on in the 1980s. That's the subject of an entire book, so I'm not going to develop that with you today. But the road to Black Monday was actually began in 1980 with some of those convulsive changes. But in 1987, the New York Stock Exchange and the Chicago futures markets, looming so large in the oil market today, almost collapsed, came within inches of collapsing. But the banks, with some attention from a smart Fed chairman, Alan Greenspan, the banks held firm and helped keep the consequences of 1987 from being as bleak as people feared. Fast forward to 2008. The market machinery was a mixed bag. The stock market held together pretty well. Yes, prices fell. Remember my lesson, prices fall, prices rise. But the market didn't fall apart. The machinery held together, so prices did eventually recover, but there were isolated crises. The mortgage market, the market for mortgage securities froze up. The market for commercial paper froze up, and big businesses relied on that to meet immediate payroll and cash needs. Some of the biggest firms in Wall Street banks nearly collapsed and needed to be rescued by the Fed. There were fewer smaller bank failures, but in any event, the Fed somehow held it all together. So that was a mixed bag. We had some markets falter and fail, and we had a lot of banks get in trouble, but we managed to limp through it. Now, we don't know today what today's crisis is going to be like with respect to price meltdown versus market machinery meltdown. I have to say, I'm a little worried about the oil price plummeting. That what you've seen in oil prices in the last couple of days is evidence of a market that's not working. It is not factually true that oil is worth zero. But oil was trading at zero because of technical factors involving the expiration of oil futures contracts. And it just wasn't working. It was overwhelmed by selling. So keep an eye on how well the oil market works, not whether the oil price goes up or down, but how well the oil market works. It's looking fragile to me right now, and I'm certainly hoping that it can pull itself together. We are fortunate that there is no sign so far, knock wood, of banking distress. Historians will tell you, and economists will tell you, that the worst recessions are those in which your banking system collapses. That's what we saw in the Great Depression, and that is what they desperately tried to avoid in 2008 with largely much success, and that's what we've got to avoid now. So far, it looks like our banks are holding up. They're not subject to any runs on the bank. People still seem to have confidence in the banks, unlike in 29. They're keeping their money in the bank. So as long as the banking system holds up, I think we can weather some isolated market disruptions. The Fed has already stepped in, by the way, to address a machinery problem, some grinding gears in the market for repurchase agreements, which are the way banks and other big financial institutions finance themselves overnight on very short terms. That market was showing signs of distress. Nobody but us nerds were paying any attention to it in the midst of all the other headlines. But believe me, I was paying a lot of attention to it because of my understanding that it's the market machinery that will get us through this. I don't really care what happens to prices. If the machinery doesn't break, the prices can recover. So I was very pleased to see that the Fed, A, recognized that risk, and B, dealt with it quite quickly. So we've got a good, smart Fed chair at work in this crisis, and we should all be grateful to that. So point number one, be sure you distinguish between the prices falling and markets falling apart. As long as markets don't fall apart, we can get through this in fairly efficient fashion. And we need to be sure that we address the issues that relate to market machinery, not just market prices. You can't talk prices back up in a broken market. So all the rosy scenarios about how we're going to have the biggest boom ever, blah, 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 that only works if the market holds together. So point number two, experience changes investors' behavior, sometimes for generations. In 1929, grass grew on Wall Street for 2 decades. Entire generations of people lost confidence in the equities markets as a place to invest or a place to put their money. They lost confidence in banks by and large, although FDR helped restore that to a great degree with the Banking Act of 1933, part of the 100 Days legislation package. But the Depression era people, my parents, they saw Wall Street as a casino, plain and simple. That why might as well just set your money on fire as invested in Wall Street. So that affected how Wall Street worked for decades and decades. It wasn't until the early 60s that mom and pop started to trust Wall Street again. And that gave rise to the enormous boom and growth in mutual funds and really the radical democratization of Wall Street as middle-class people began to invest through mutual funds and benefit from the capital building process of investing. So, but how long did it take to recover from 1929? Most people are really shocked when they see the answer. Stock market did not return to its pre-1929 crash peak until November 1954. That is how long it took for the great bulk of American investors. And remember, these were times of great prosperity. We had the war boom. People were making money in the 40s and in the 50s, but they weren't putting it in the stock market because of the trauma of the Great Depression of 1929 to 1932. The market regained its post-crash peak, or actually the market in 1929 after the crash bounced a little bit into the spring of 1930, but then it began a slow, gradual decline that continued into July of 1932. So that's a 2-year bear market, 2 years in which the market does nothing but decline. It finally ended down 90%, roughly, about 86% below its 1929 post-crash levels. So these have long tails, these experiences. In the 70s, there was a completely different set of circumstances. The 70s had 4 major bear markets. There was a bear market in 1973, in 1974, in 1976, in 1978, and just very mild bull markets in between those. Basically, the 70s were a lost period for investing on Wall Street, scarred by oil shocks and escalating interest rates. The prime bank rate by the late 70s actually hit 20% interest rates. Who's going to invest in stocks when they can get 12% on a government bond. So and that experience rendered a whole generation. I was a young bride at that point. I was trying to buy groceries and heating fuel for our house in a time when the price was going up every month. So I'm the inflation wary generation, people who are so nervous about inflation that we sometimes don't think quickly or clearly enough about when we need some inflation. And deflation is the definition of a depression, prices falling. And sometimes inflation is exactly what you want. But the politicians who know that and the economists who know that are dealing with baby boomers like me who say, oh my God, the tuna fish was going up every week, a new label on the tuna fish can in the grocery store. So this has long tails. These lessons have long consequences. It obviously the muddled reaction to the 1970s crises, the oil crash, the interest rate crash, and the resulting recession helped give rise to a durable argument, principally among the GOP, among Republicans, that government was the problem. It was the problem with our economy. Our economy was broken because of government, and that government was not the solution, it was part of the problem. And so that notion of reducing the role of government in the economy grew right out of the 70s and the mismanagement of a long-running, grinding economic and financial crisis. In 1987, a different outcome. The rebound after 87 isn't as quick as we all remember. In fact, I interviewed people who actually lived through the 1987 crash, and I'd asked them, I said, so how was the crash? They said, oh, everything was over by the end of the year. Well, that was patently false. I mean, people have a whole set of completely false memories about 1987. It took 2 years for the market to recover after 87, and there was another mini crash in 1989. But what the average investor took away from both of those two experiences was buy the dips. A market crash is your opportunity to buy blue chip stocks cheap. So that trained a new generation of investors with the idea of stand pat during a market crash, stay the course, buy on the dips, and that you'll come out better in the long run. So that mantra essentially kept the middle class in the market right up and at least through the dot-com bubble collapse of 2000, which alienated a lot of investors, but that wasn't a significant enough crash for me to include it today. But again, buying the dips, investing in great companies, seeing them grow, seeing your portfolio grow, all of that reinforced the idea that the private sector was the most important component of our life as citizens. The market was going to take care of us. Private companies could do everything more efficiently than public government could. Again, further reinforcing the idea that government was the problem and giving rise to reduced budgets, reduced appropriations, reduced attractiveness of government as a place to work for bright, sharp people like you guys. So the private sector was further lionized, and there was a further erosion of faith in the government in the aftermath of 87. In 2008, every asset class was affected, including home ownership, which was the biggest trauma for most American investors. Every kind of financial institution lost favor with the general public. Those lessons were slowly fading before we hit this. But the hostility towards the government that designed that relief response remains. So today, what are going to be the changes we can expect based on what people are experiencing today? It's a little too soon to tell in terms of investor reaction. The market is very different today in that it's more highly institutionalized. So far from what I'm seeing and hearing, I'm not hearing people throw up their hands over the stock market. They're not blaming the stock market for the crisis surrounding the pandemic. It would be illogical and irrational to do that. So I'm not sure how this crisis is going to affect investor behavior, except with one guess, and this is just an educated guess. I think you're going to see every sector of the investing public, from big institutions and endowments all the way down to me, maintaining more cash. The pandemic has educated us that with no notice, you can suddenly lose all your income. And so the idea of a rainy day fund, the idea of a cash cushion to see you through a crisis, has been pounded into the skull of every person living through this experience, especially young millennials and younger workers who have lost their jobs or fear they'll lose their jobs. So I think going forward, we're going to see a greater demand for liquidity. People are going to want that rainy day fund. That necessarily is going to affect how much money they're willing to invest in riskier securities. The whole risk tolerance may greatly decline as a result of this experience. But those will be very interesting things to watch. And you'll want to watch things like the popular investment newsletters. What a year from now, what's Charles Schwab saying? A year from now, what's Ameritrade seeing in terms of investor behavior? What's happening to money market funds versus longer term investments? Are we seeing more money rushing into money market funds than the others? So we still don't know yet, but those are things that could happen that could affect all of the markets. When money moves from one market to the other, the market it left becomes less liquid. When you want to sell something, you may have to take a bigger price cut. When you go to buy something, you may have to pay more than you want. So those are going to be the interesting investor reactions to watch from today's crisis. Now, finally, political consequences will be unpredictable, but they will be inevitable. Every single one of the crises I reviewed for you today, and countless others I could put up on the screen, have had dramatic political consequences. Look at 1929. In 1929, the Republican Party controlled every lever of power in America, not just Congress and the White House and Republican appointees to the Supreme Court, but virtually every state house, state governments. The Republicans had ruled for a decade since Warren Harding's victory in 1920. By the way, he was running against an Ohio governor named Jim Cox, and the vice presidential candidate on the Democratic ticket was an attractive young man named Franklin Roosevelt. 1920, the Republicans took power and unleashed the biggest bull market anybody had ever seen, the Roaring 20s, as they called it. It was a time of incredibly radically increasing wealth and radically increasing inequality across the board in the country. 1929 came, the market crashed. The initial reaction was, oh my God, it had to crash. Eventually, we had a correction. Now everything's going to be fine. The market rebounded about halfway into April. And on April 17th of 1930, it turned, and it did not recover for 2 years. 1930 midterms, what do you think happened? Yeah, the Democrats made enormous gains across the board. Still not quite enough to take the Senate. They were very close, but they made enormous gains across the board. Herbert Hoover was still very confident that the Republicans could hold their levers of power. And he went into the 1932 election in a state of denial. By 1932, the American unemployment rate, and it's just a guess, we didn't have the statistical, robust statistics then that we have now, but the employment rate was certainly 25%, quite possibly higher. Economic activity had come to a dead halt. People were scavenging garbage heaps outside Chicago for food. They were living in tents and caves. There were cardboard shacks in Central Park. There are photographs you can look up to see just what kind of hardship America was enduring while the Hoover administration insisted that it was all going to turn around any minute. And it wasn't government's job to see to the personal welfare of citizens. Its job was to make sure that the country was safe and that everything worked. So there was a vast repudiation of that political position in the 32 election. Roosevelt won by a landslide. And then he enacted the New Deal, and the Republicans at the time said, well, people didn't really understand what he was going to do. They were just rejecting Hoover, and now that they've seen what he's going to do, they're going to reject it. They didn't. His 36 landslide was even bigger. So the political consequences of the 1929 crash were epic. They lasted for 2 decades, and there was just no turning them back. The 1970s, the sense of a failed economy, a failed government, gave rise to the Reagan Revolution, which continues to this day in terms of the commitment of the entire GOP and conservatives among the Democrats to deregulation. The whole idea of deregulation arises from the disgust with government that emerged out of the 1970s. 1987 and the aftermath of that, continuing faith in the stock market helped preserve the GOP's trends towards shrinking government and lionizing the private sector. And so essential government functions continued to be defunded and understaffed. 2008, we still don't well understand the political consequences of 2008. I've read dozens of very thoughtful analysis about this, some of them from the great political scientists at GW who are studying this very carefully, trying to figure out what drove the electorate in the after the 2008 crisis, trying to draw a line between that crisis and the political consequences in 2016. We don't clearly understand the rise of the Tea Party. How much did the foreclosure crisis contribute to that? How much of it is unleashed racism? How much of it was just a sense of elite scorn? We just don't know yet. But one thing we did emerge from the 2008 crisis with political consequences was a sense of deep grievance among voters and hostility towards bailouts. Now, I hate to use the word bailout. I always put it in quotes in my mind. So a bailout in all the instances that we have referred to it in 2008, in 1987, is a rescue of an essential operation. When you bail out your banking system, you are rescuing an essential system for the functioning of our economy. And yet this hostility towards bailouts, it remains to this day, as we are seeing these desperate attempts to soften the economic impact of the pandemic. We're seeing that rhetoric arise. Now, to my astonishment, we're seeing Republican senators and congressmen voting for massive relief bills, which frankly is a lot more historically astonishing than I'm making it sound. But the stigma attached to bailing out big institutions, big businesses, big banks remains. And I'm seeing in my Twitter feed, you're seeing it in the commentary I'm sure that you're reading. Let's not let all this this rescue money, this relief money, go to the big corporations. You know, they shouldn't have it. They did stock buyouts. They pay their executives too much. Deny them. Well, I'm sorry, folks. They're part of the functioning economy. We have to get back on its feet. Yes, we need to address the needs of small business. They don't have the cash cushions or the access to bank loans or the access to the commercial paper market that big companies have. But we can't run this economy if all of our blue chip Fortune 500 companies are bankrupt in 3 years. So we've got to be grown-ups about where bailout money goes and what bailout money goes. So what will be the consequences of today, the political consequences of today? We'll know soon. I mean, that's the neat thing about this. We're going to know in November at least what what the early stage consequences of the 2020 crisis have been. In my most optimistic moments, I hope for a recognition of the importance of competent government. We've underfunded our essential functions of government for so long, by which I mean decades and decades and decades, that we've reached the point now where we have an IRS that is so overwhelmed by this crisis, they can't get refund checks out to people who desperately need those refund checks to make the rent. We have underfunded our public health organizations at the federal and the state level. We've underfunded our jobless services at the federal and the state level. So we're left with key departments like Health and Human Services, which at this moment is being run by a former federal prosecutor in Miami with zero experience in running Health and Human Services. The same can be looked at all across the current administration. We have people selected for jobs without any consideration of what practical skills and experience they had. And as a result, we've got a completely chaotic and incompetent response to a serious crisis. So I think one potential political fallout from this crisis could be a demand for competence. That's in my better moments. In my worst moments, I fear that we're going to see an increasing rise in xenophobia, in every man for himself, in looking out for number one. I've got mine. You look, pulling up the drawbridge, putting on the masks, going into our fallout shelters, basically, and letting everybody fend for themselves. One of the great things that FDR accomplished when he stepped into power in 1933 was to address that kind of class division and anger and hostility by emphasizing that we were all in the same boat. Americans together are going through this. Americans together are in the same boat, and we all get rescued or we all sink. So if a pandemic does not force us to recognize that we're all in the same boat, there's no safe place. If you've underfunded your public health operations to save taxes for the rich people are going to die too. So this could be an epic political change. Or it could be over quickly enough so that, like in '87, we just say, oh, okay, well, that was pretty bad, but now it's over and we don't need to learn anything. So my hope is that won't be the case. Those were the points I wanted to raise, Elaine, and I'm happy to field questions or further discussion.
Great. Thank you so much. That was I've been taking notes. I have lots of notes. A lot of food for thought. And I mean, one of the, I'm not sure there's a question in there, but one of the things I had thought about before we started this session was this, I want to put it so eloquently, but the difference between the prices fluctuating and the market machinery being in place, because what little I know of from history, my history classes and such, of the 29 crash, in particular with the Depression and everything, was that there wasn't all of the machinery in place, and like with the banks failing and such, and the stories of people putting cash under their mattresses and not trusting the banks, and then a lot of the institutions that we know now today came out of that crisis, like the FDIC and such. I mean, that's the one I can remember. But
the Social Security was born in that era as well.
Social Security, yeah.
But it's interesting. A lot of people who a lot of politicians who lobby for deregulation have actually never experienced a deregulated market. And if you told them, fine, we're going to eliminate the New Deal regulations, no more deposit insurance, and their faces turn white. I mean, it never occurred to them that they would give up deposit insurance. The FDIC has been a critical factor in instilling confidence in the banks. That doesn't mean they can't fail. Some of the banks nearly failed in 2008 because of their investment activities, not because people were panicked and created a run on the bank. So, but you're right that we have strengthened some parts of the machinery over the years in really significant ways.
Right. Yeah. And so that was one of the things I was just, I'm glad that you pointed that out, because, beginning March, when the stock market was first going down and everything, and you look at the media and they're so focused on the points going up and down and making it seem like it's worse than it is. And I guess I was comforted by the fact that I was thinking about these other crises when I knew that some of these institutions had been put in place. And so I wasn't in my mind panicking as maybe some people, if they didn't know about this history. So I appreciate that very much. Somewhat related to that, there was a question that was sent in that I'll just read it off and add something, but it's traditionally recessions reveal shady accounting and outright fraud in the corporate ranks. Will things be different this time around because of regulatory oversight / corporate governance improvements? And we certainly have some of those. I think, I guess the other question I would add on to that is this current climate under the Trump administration of trying to kind of deregulate some areas, and do we have enough of those regulatory institutions and such in place, or have they been weakened to ferret out some of this fraud because what's going on rapidly?
Your questioner there is absolutely right that times of great financial distress do give rise to chicanery. Businesses are under pressure to try to make their numbers look good, enormous pressure to cheat on the books. Investors are desperate to get some kind of investment return. So they're vulnerable to the con man who comes in and says, oh, I've got this great little bond fund that can pay you a nice, tidy little dividend and just give me your money. So the climate for fraud is certainly fed when times become uncertain, and when income becomes hard to get. So I'm telling, when I talk to regulatory audiences and legal audiences, I'm telling them that the decade of almost zero interest rates, which has made it very, very difficult for retired savers to earn any money with their money, has been a field day for fraud. Those low legitimate returns mean that people are going to be desperate to get just a little bit more. You don't have to offer them 50% a month to lure them into your Ponzi scheme. Offer them 3% a year and they'll be happy right now. So that it is a danger. Are we defended against it by our regulatory structures? Well, there's good news and bad news there. We have a lot of the statutes that we need to address corporate fraud and investor fraud. But two problems stand in the way of that being done effectively. That's the bad news. The good news is both of them can be fixed. The two problems, one of the problems is Balkanization. We've got too many regulators competing in the same marketplace. And this has been an evident risk since 1987. The Blue Ribbon Commission that addressed the 1987 crash, its biggest conclusion, Brady Commission, you can look it up, was this balkanized regulatory system where we've got one regulator for the banks, another regulator for the securities markets, a third regulator for the futures markets, 50 state regulators for banks, securities, and insurance. So we've got this balkanized, duplicative regulatory system where nobody can get a 360-degree view and has the authority to act in any place in the marketplace where a fire has broken out. So the balkanized regulatory system was identified as a threat in 1987. It was identified as a threat after 2008, again by Republicans. These were Republican commissions. The Brady Commission, Nicholas Brady was a lifelong Republican. Republicans testified in Congress in 2009 that the balkanized regulatory system of 2008 made it extremely difficult to deal with the crises that were emerging on so many different fronts. An insurance meltdown at AIG, well, that's one regulator. Stock market meltdowns, the money market funds, the commercial paper market, that's a different regulator. So the problems were myriad, and the urgent message was, we've got to do something about this balkanized regulatory. Two Octobers ago, a year ago October, the Treasury Department under Trump, Steve Mnuchin, put out its report on the capital markets. And in the executive summary on page 910, you can find, dear, oh dear, we have this balkanized regulatory system that's a real danger, and we need to do something about it. So we need to streamline our financial regulatory system. The political obstacles to doing that are enormous, but if there's ever an opportunity to do it, the aftermath of a catastrophic crisis might be that time. So the bad news is we're still balkanized. The good news is the institutions are there, and if you put better people in charge of them, they can turn them around. As to gains in corporate governance, there's certainly been a move towards more transparency among publicly traded companies, but there's been a departure from publicly traded companies. More and more of our big employers, big investors, big powerhouses in the economy are privately held. So we don't have the same kind of visibility, transparency, disclosure, and they are not prone to the same kind of regulation that publicly traded companies are. They fall only under business activity regulation or anti-pollution regulation. So I think you're still going to see the same level of corporate misbehavior that was exposed after 2008. And by the way, after 2000, after the 1970s, after 1929, these crises, as I think Warren Buffett famously said, when the tide goes out, you see who's swimming naked. Well, when the tide goes out in the financial market, you see who's been misbehaving. So I'm not expecting a wonderful decrease in corporate fraud or in a great increase in corporate governance. That would be too much to hope for. But I am hoping for an awareness that we need a more modern regulatory system to deal with what is essentially all one marketplace now. Not a world where people trade stocks over here and they buy insurance annuities over there and they trade futures over here and they buy real estate over there. It's one marketplace with the same players moving rapidly from market to market. And we need a regulatory system that reflects that modern reality. Whether this will be the occasion when we can get it, it remains to be seen, but I'm hopeful.
Okay, thank you. We had another question, maybe somewhat related to that, but then pulling in kind of your optimistic outlook for things. But do you think that there is a reasonable possibility that we could emerge with a new and more egalitarian financial ecosystem? So with that modern, so like the modern one that you just were talking about, could that lead to, we, like you said, even before, like in 1929, there was just so much, the inequality was just rapidly kind of gaining, and we feel like we're in a time like that again.
I am hopeful. I mean, the two enormous fault lines that have been exposed by this crisis, one of them is the incompetence. That is the danger of letting your essential services become incompetent, unable to function. The other is the inequality. And if you're paying any attention at all right now, you're understanding that inequality is bad for everybody, not just for the people who are adversely affected by it. Case in point, we need to get this economy going again, right? We've got to get money out there in people's hands so they can start buying and meeting their basic needs, right? So we design a program that will pump money out, payroll protection plan. Who gets it first? The people who already have bank accounts with big banks. People who don't have bank accounts, who deal with smaller banks, those small businesses, they're still waiting in line. So yeah, they're hurt by the financial inequality built into a large, small banking system. But so are the rest of us. We need those people to get that money and get out and spend. Similarly with schools. Okay, we didn't want to spend any money, tax money on schools. So now we've got to shut down our schools, and we discover we've got some students with inadequate Wi-Fi, inadequate devices who cannot participate in the education system. And we've got, and those are in surprising places. So if we're going to have an education system, we've got to address the inequalities on the technology front. That now turns out to affect all of us because the teachers, the schools cannot conduct classes. You know, my kid may have the latest Mac, I may have the very fastest modem in my life, but if my school doesn't, if my neighbors don't, then I'm not part of this community. So I think there are lessons coming out of this. The third example that comes to mind is the issue of prisoners. I've got a good friend who works for a nonprofit media organization called the Marshall Project. The Marshall Project reports on the criminal justice system. And right now, of course, what they are most focused on is the cases of COVID-19 in the prison system. Now, in the harsh world of inequality, there are a lot of people who say, you know, I don't care what happens to prisoners. They broke the law, they've been locked up. I mean, we've got to worry about what's happening to our healthcare people, what's happening to our first responders. You know, who cares about prisoners? Well, it turns out when they get sick in prison, where do they go to be treated? Your local hospital. When a plague breaks out in the prison, where do the workers go at the end of the day? Home to their neighborhoods and communities and grocery stores and drugstores and liquor stores. How do they get supplies for the mess hall and the linens and the laundry? Vendors come in and deal with them. If there was ever a crisis that proves that John Donne was right, no man is an island, it is this one. So this is putting a completely new light on the issues of inequality. And if we're alert to it, it will show us that inequality, if you're among the privileged, isn't something that happens to somebody else. Inequality is something that weakens the whole capacity of the society to respond to a crisis like this. Unequal health care means that more people walk around sick and infect us. Unequal education systems mean that more kids fall behind, can't compete, can't get the jobs that we need, can't fill the jobs. So we're getting a crash course in the truth of John Donne. We are not islands. We're in this together. And addressing inequality, not just as a charitable act, you know, not just because, you know, it's the right thing to do. I am my brother's keeper. That has never sold very well in the political arena, although an inspired leader can sell it. We saw FDR do that. But I've got to attack inequality because it affects my own health, safety, and progress. That might sell. And we're emerging from a crisis that is teaching us that on a daily basis.
Well, thank you for that. We had a couple more questions, but I feel like we've covered a lot of what was in that from your previous remarks. I really want to jump on your optimistic side of what could happen, because obviously there's a lot happening right now. You can very easily just focus on the pessimistic, and we would just be in so much worse shape, I think, if we went to that side of things. So I thank you for all of these insights and the history. I hope everyone online with us today has appreciated as much as I have. And I'm going to keep my fingers crossed that optimistic viewpoint prevails. I really do hope so. Do you have any further, like one final thought before?
Just one. I understand that it may seem irrational to be optimistic right now, but I want to remind you, I've been spending the last 3 years deep in the archives of the New Deal. That's what all these books behind me here are. And it has reminded me that as a country, we can do great things. We can do big things. You look at what was accomplished in the depths of the Great Depression, it cannot help but make you optimistic about what we can do now with all the technology we have now, all the resources that we have now that they didn't have then. What we can do now should make us all hopeful and optimistic. What we got to do is come together and get it done.
Exactly. And we have come together as a country for more than 200 years in many, many different crises. So I do have hope that we can do it again. It's just like when we're in the throes of this, I think it's hard to see that, but I am very optimistic in that sense as well. So thank you again so much, Diana. I really do appreciate this.
I love being with you. I really did. It was a great experience.
Yes, and for everyone online, we'll send out thank you email as well for the upcoming events, but also I will redirect people back to Diana's own website, where she posts a lot of the interviews that she's had with various media outlets, and you can read more about her upcoming articles and books and such like that. It's a wealth of information, and I love seeing your Twitter feed there too. So. Thanks so much again, and I hope everyone has a good day. And it's in DC, at least it's nice and sunny. Maybe you can get out for a walk and stay safe and healthy again. So thank you so much. See you soon.